This is Financially Fit Radio with Cory Sickles from Safe Harbor Wealth Advisors. Retirement isn't just about saving, it's about having a strategy that helps you navigate market ups and downs, combat inflation, and secure the future you deserve. That's why Financially Fit Radio is here to tackle your biggest financial concerns, share actionable strategies, and help you move toward your retirement goals with confidence. And now, here's Financially Fit Radio with Cory Sickles.
Welcome back to another episode of Financially Fit Radio. I'm Cory Sickles with Safe Harbor Wealth Advisors. If you have any questions about today's meeting or today's show, just feel free to give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. And while you're on our website, feel free to click on that radio page. You can listen to today's show, previous shows. You can also subscribe to our podcast on Apple Podcasts, Amazon Music, or Spotify. Also, feel free to watch today's show on our YouTube channel. Just type in Safe Harbor Wealth Advisors. You can go to our Financially Fit radio playlist. You can watch today's show, previous shows. You can also subscribe to our YouTube channel and be kept up to date when we put new videos out. We do about 4 or 5 different video shorts a week on different types of financial topics. You know, we're here to help and guide you to make sure you have the best retirement that you possibly can. So again, if you want to give us a call at 614-760-0670, or again, visit our website at safeharboroh.com. You can set up a complimentary, no financial obligation meeting with us. Well, today we're going to just kind of talk about 2025. Where are we in the economy? So it's going to be more of a economic checkup. We're going to talk a little bit about, you know, the growth of the economy, inflation, and just some other types of things that kind of have an impact on your finances or on your investments as well. But before we dive into that, let me introduce to you my co-host this week and every week, and that's Tony Shore. Tony, how are you today?
Oh, I am doing great, Cory. Having a good time. I had a great week. You know, I was off last week. Actually took a little family vacation. I haven't taken a week-long family vacation in a couple of years at least. So that was fun.
Well, you know, the hardest thing to do, Tony, is the first day back on the job.
Oh, today has been a tough one. Today is the first day back, and it's been a tough one. I got to get back into the swing of things, but I'm glad to start my day off with you, Cory. That helps. This is going to be a fun show. How have you been? Are you working hard over there?
Yeah, you know, it's hard to believe we're already in August.
Yeah.
I mean, it's hard to believe that. Yeah, things are going good here at the office. Now's going to be the time we really start to get busy. You know, during the summer, it's a little bit, you know, people relax. They're doing vacations like you just got back from. They're doing traveling, things like that, watching their kids play some type of summer sports. But, you know, now it'll be a time for people to start focusing more back on their retirement, their finances and things like that as well. So yeah, it'll definitely get busy. The one thing, Tony, I just can't believe how much rain we have received this summer. I don't know about you guys up there, but it seems like we've got a lot of rain. Last weekend, you know, we had some good thunderstorms again this weekend. I don't know what the outlook looks like coming up, but you know, hopefully, we'll get some dry spells in there as well.
Yeah, we had a huge thunderstorm here last night, and the dog was cowering behind the couch because of the thunder. We had a big lightning storm, and I noticed today on my drive when I got up, a lot of branches down in our yard and our backyard, so I'm going to have to pick those up. And throughout the streets in our neighborhood, I saw a lot of branches down. So we had a lot of rain and a huge thunderstorm with wind. So yeah, that's interesting. We needed the rain, but other than that,
you know, it's amazing on how much rain we received, and we didn't get rain for like a couple of weeks, and how dry the grass or the ground gets. I guess a lot might have to be do with the heat and the humidity as well.
I think so. But, our lawn was starting to get brown too. It had only been a couple of weeks since it rained.
Yeah, I know.
Yeah,
we had so much. I guess it was just the more it receives, the more it wants.
Yep, exactly. So what are we talking about on the show today?
Well, Tony, I thought we would just do like, just a check in on where we are with the economy. Um, a lot of obviously it's in the news a lot, right?
Hmm.
And really that one of the first things I kind of want to talk about is what we call our GDP growth rate. And really what all that represents, Tony, it's the total value of all goods and services produced within a country's borders during a specific time period. And right now, it is positive. We're looking at right now about a 1 or 2% annualized growth rate on our GDP. That also means it's slowing a little bit. I think we'd like it a little bit higher. But the positive part of it is it is expanding, but it is really going at a slower growth rate.
Yeah, it hasn't stalled out, but it is slowing. And I guess that means the economy is still expanding, but at a slower rate than before than we hoped for, right?
That's exactly right. We'll see how all this, obviously, on August 1st, all these new tariffs are going to go into place. We'll see what kind of impact that has on our economy, our GDP, really 3, 4, 5 months, 6 months from now. Obviously, you're not going to be able to, we won't know it until all the numbers come out of what that actually looks like. I think another big thing in the news, constantly anymore is inflation, right?
Yeah.
The Federal Reserve wants us at around a 2% growth rate or an inflation rate on an annual basis. I think last month it came in around 2.7, 2.8%. So it's still a little bit higher than I think what the Federal Reserve wants. And I'm sure it's a little bit higher than the consumer, want as well.
Sure. Sure. The lower the inflation rate, the better typically. Anything under 3%, I consider pretty good. We'd like it around 2, though.
Yeah. I mean, obviously, when we see prices go up, I mean, you're really going to feel that when you go buy groceries. I think everyone realizes how much groceries have gone up over the last few years.
Yeah.
I think that's an easy thing to be able to go check. But the one part of it we really have to look at, Tony, is our wages going up at the same type of rate as inflation. And I think in many cases over the last few years, that's not the case, which means we, the consumers, have reduced spending power, which means because things cost more, we're not being able to buy as much. And we'll kind of talk about a little bit later with that when we start talking about consumer spending as well. But obviously, if things cost more, it puts a little bit of a financial crunch on everyone's pocketbooks, right?
Yeah. Yeah. And it can put a strain on wages and savings. So, if your wages are stagnant because things cost more, maybe companies aren't giving as big of raises, possibly. If your wages aren't going up at the higher at a bigger rate than inflation, you're kind of moving backwards, and that could affect your savings as well, right?
Yeah, I mean, it definitely has an impact on savings as well as investments too, right? The one nice, I guess, the one nice part about when we start talking about inflation is obviously it has also an impact on interest rates too, right?
Yeah.
And I think what a lot of people are expecting is interest rates to be able to drop. However, one of the things that we're seeing right now, Tony, and over the last few years is when interest rates have actually increased, what's that actually mean with your savings? Well, I mean, you're actually getting higher CDs, higher money market. So a lot of those fixed type of investments or safe type of investments are paying a higher premium than they were, 4, 5, 6 years ago.
So it is going to have inflation has an impact on and interest rates have an impact on your investments, obviously, right?
It does.
Yeah.
Yeah. So when we start talking about higher interest rates, the nice part about that is on those type of securities. But the other side of that, though, Tony, is I think everyone understands the other impact of that, right? Mortgage rates.
Yeah.
Increased borrowing for consumers, but more importantly, it's also increased borrowing for businesses, which means maybe businesses won't invest into who knows what. It could be technology, it could be product development, but more importantly, it also could be people. And we're talking about investing, people, wages, things like that. So that could actually have a huge impact on the other side of that we talked about a few minutes ago. If you aren't making as much, but inflation's still going up, now you're going to have a little bit more of a crunch on, when you're trying to go and just buy your everyday goods.
Yeah. Yeah. I think that's a good point. Now, what about the unemployment rate? Where's that at?
Well, right now the unemployment rate's kind of right around 4%, Tony. So, but in some sectors, especially retail, and right now, I would say technology, some of that is actually slowing. So, of course, as unemployment rises, consumers can get anxious, right? And if you get anxious, what are you going to do? Well, if you think you're going to lose a job, or maybe you're not going to get that pay increase as well, Tony, you might not be able to actually go out, and you might be trying to not buy as many products and services too. Now that actually has a huge impact on our GDP, what we talked about, but it also has an impact for companies making money, which could actually then affect the market as well. So, when people are fearful about being able to possibly lose jobs, then that can actually have a huge impact on consumer spending.
Yeah, and the unemployment rate is important, and it's still low at 4%, but hiring is starting to slow. So I know there's some concern about that. I'm glad you brought that up. And like you said, it can trigger that cycle where reduced spending impacts the economy and job market. So it can be a vicious cycle. And I think the Fed and our government and everyone wants to avoid that spiral, right?
That's exactly right. And I think they want to avoid the spiral of it. And obviously, if unemployment does creep up or wages aren't increasing, that's going to have a huge impact then on the way the consumers spend money.
Yeah.
Right. And if we aren't making as much money, but you still have to go out and buy groceries and other, some of your essential things. The one thing I will say, Tony, is the average American household credit card debt, and has actually increased. So the total debt reached $1.18 trillion in the Q1 of 2025, Tony.
Oh, and that's the average American household credit card debt.
Yes.
Is over $1 trillion.
Yep.
That's amazing.
So households with high debt to asset ratio, now that can actually have an impact on whether now you might not pay your bills, become delinquent.
Yeah.
Now you're getting into potential financial instability. So all these things kind of go into play. And I'm not trying to make it sound like we're in a crisis here, but we do know that credit card spending is going up, which means people probably are not increasing or keeping up with the pace of inflation. Because in order to buy a lot of their essentials, they're probably putting on a credit card. Now, a few minutes ago, Tony, when we talk about interest rates have gone up.
Yep.
That means credit card interest rates have gone up.
Yep.
Which means people are paying more now, even though you might be putting it on the card and you're not paying that off on a monthly basis. Now you're actually paying more because of the interest rates.
Oh, a lot more. Yeah. Up to 30%.
Right.
Anywhere between 22 and 30 is the range right now for credit card interest, which is terrible. I mean,
that's exactly right. So now you kind of get back down to if they do lower interest rates, yes, it's a good thing. Mortgage rates go down potentially, right? Now credit card interest rates go down as well. However, some of the other parts of that might end up being that all of a sudden the savings that you were putting in CDs and things like that, now they're going to make even less money. So, it's a tough balance to kind of figure out whether interest rates should go up or down. I think for so long, Tony, people were willing to not pay hardly anything. They love 3% mortgage rates, even though you couldn't make 1 or 1.5% in a CD in the bank. I think people were liking that because also the market did well and things like that too. So obviously we have the tariffs coming about. Now the Fed's going to have to make a decision. Are they going to be able to lower interest rates? And if that is the case, from an investment standpoint, Tony, you might actually have to be looking at different things to invest into to try to be able to make money, because you won't be making as much money when if you have it in safe investments like in bank accounts.
Sure. Sure. And so you have to look at those types of things because you want to make sure your money is where it can work for you. And depending on if you need it liquid or if you have time on your side where you can put it in more long term. And that's something you help your clients with. And of course, what the Fed does is going to impact a lot of things. Are they actually going to? They've paused. It seems like they paused the rate hikes. They paused the rate lowering. I don't know. They're on hold right now. A lot of people thought they'd be lowering rates some more by now, but they haven't yet, right?
They have not. They have not done that yet. I mean, obviously, President Trump obviously wants Chairman Powell to be able to lower those rates. It hasn't happened. I think there's a lot of pressure about whether he's going to try to be able to push him out. Powell says he's going to hang on till May of 2026. But, that's obviously something to look at. But I do think if we do see a little bit more of a tick up in inflation, I would imagine the Fed will do something in order to lower those interest rates.
Yeah.
Then you kind of have to look at, where am I going to be able to make money? There's a couple things that, we offer our clients. We have fixed we have fixed rates. For annuities. You can go out and get a 2 or 3 year fixed, or even a 5-year rate on an annuity as well, depending on, but it's going to be at a fixed rate, whether you want it 4 or 5 or 6%,
like a MIGA.
Yeah,
Right?
they're called MIGAs. Yeah. And the nice part about that is it's still like a CD. It's going to lock in for a few different years. We're an independent, Tony, so we have access to a lot of different types of companies, and really what we're looking for is A-rated companies that our clients can invest money into, and we're going to put in an A-rated company with the highest fixed rate for whatever time period you want.
Right.
So that's one way.
That's typically that they outperform or have better rates than CDs at banks. So that's one thing, an option you need to look at least if you are looking for that principal protection and a fixed rate, right?
Yeah. The other one we have, Tony, is we have we've talked about our buffered products too.
Oh,
so
yeah.
This allows you to invest in the market. Right now we have one that you keep it in there for 18 months. It's based upon the Dow Jones and the S&P 500 performance. But right now you can make up to 12.7% over that 18-month period. But the nice part is you're 100% protected on the downside of the market.
Yeah.
So
that buffered index portfolio is a good one, isn't it?
That's exactly right. So, if you don't really want to, if you want to be in the market, but you want to have protection, a buffered type of product like that's great. And it gives you the potential to, potentially make up over 12%. Obviously it's all based upon how the market performs, but if it goes on the downside, you are going to be able to be protected on that too as well, Tony.
Yeah, it's the principal protection you're looking for, and everybody's situation is different. So what you need for your situation and how much you should allocate in these different options, vary. But it is good to know you have these options and know that there might be better options out there. And if somebody's just trying to steer you in one direction, work with a trusted fiduciary who's independent, who looks at all the options and says, oh, for you, there's this option, which is really good. So I think that's really important to note.
Yeah, you're exactly right. Again, we have all kinds of different types of products to be able to try to outpace inflation, or at least keep up with inflation. And again, just schedule a complimentary, no financial obligation meeting. We can kind of give you some suggestions or some solutions in order to meet your needs as well.
Yeah. Yeah. So what's going on in the stock market, though? I mean, obviously, that's long-term investing. I know most of your clients have at least a portion of their money in retirement funds in the stock market. And a lot of people may have all of it in there if they have 401ks and IRAs before they retire. So what's going on there?
I think this year, I think it's been a little bit volatile, right?
Sure.
Back in April when when President Trump announced the
Yeah.
tariffs.
Yeah.
Market dropped around 17, 18% at that particular point in time. Now we're in a positive. It's come all the way back. We have a new set of tariffs coming out on August 1st. We'll see what kind of impact that has. Right now he's cut deals with, Japan and now the EU. I know he's now trying to still work something out with China. So we'll see how all that plays out. But, even when you look at EU, there's going to be a 15% tariff on most things coming in here. My guess is companies got to look for alternatives, right? You either got to keep buying it from where you are, whether it's the EU or the Philippines or China or whatever that is, or you're going to have to try to find some type of, I think this is what they're trying to hope for, is you're going to find some type of suppliers in the United States to be able to fulfill those needs. Now, obviously, if you keep buying it, Tony, from overseas, everything, it's going to be 15% more. Or 10% more, or whatever kind of deal they're actually cutting. So we can feel it as the consumer, when we start purchasing things, if we cannot find another supplier here in the United States.
Yeah. Yeah, there you go. And so the tariffs, once again, are in the news as far as how they're going to affect the market. And we'll see what happens in August. We'll see what happens when these new ones take effect. As of the recording of the show, they haven't yet, but it looks like deals are being made. That's a good thing. But he's talking about a global baseline tariff at 15 to 20% globally for all countries. And so that could impact the stock market if that goes through with no deals. But again, he says these things and then deals are made, right? So
Yes.
we, at least in the past, we'll see what happens here.
Yeah, and the other part of it, when we start looking at a lot of things, Tony, the market's always looking ahead.
Yep.
We don't know as of today. I'm not really sure on how much it's actually processed in tariffs. We're going to find out, I think, next week.
Sure.
When all the stuff comes out and whether the market likes or doesn't like, what takes effect here, in the next week or not. But, but I think they're also expecting interest rates to be lower at some point in time as well. And if that doesn't happen over the next couple of months, then I think the market could get a little bit antsy, and you'll see a little bit more volatility in that, because I think the market is expecting at some point this year to see a decrease in interest rates.
Yeah. Yeah. And in all of this, some people look at bonds or the yield curve, and the yield curve is still inverted, right?
Yeah, slightly.
Yeah.
But really what we're talking about is the 2-year versus the 10-year treasury, Tony.
Sure.
So an inverted yield curve occurs when the yields on short-term government debt are higher than the yields on long-term government debt. So that's the opposite of a normal yield curve, where longer maturities should offer higher yields. So inversions like this could also indicate, when you start getting that inverted, that means it also could indicate a recession could be possibly coming as well.
Sure.
We're not there yet.
No,
but
and this one, and it seems to be less. The inversion was a lot bigger. It's a slight inversion right now, right?
Right. It was a lot bigger a couple years ago.
Yeah. Yeah. 2022 was a big one, right?
That's exactly right.
Yeah.
So it's just, all these things that we're talking about today, I think, if you're trying to educate yourself, these are some of the things you just want to keep up to date on to see how things are going. But here's the one thing: just because you read this stuff, don't all of a sudden take the emotion of all this and change the way that you're actually invested. For our clients, we're looking at more of a long-term, Tony, right? So we try to take the emotion out of what your long-term plan is. We know the market's going to go up and down. Right. But you have to make sure that your risk is allocated the correct way. You have a financial plan. You're diversified, so all your money's not in stocks. You want to be able to have it in multiple types of products in buckets to be able to have a successful retirement. So if you work with an advisor, you take the emotion out. We're here to help and guide you to make sure you have the best retirement that you can. And These are just some indicators that I think you should just be aware of, but don't let all these things influence the way that you actually move your money around.
Yeah, and have a plan. And you can set up a no charge, no obligation consultation. Cory, you love to meet with people. How can our listeners and viewers do that?
Yeah, just give us a call at 614-760-0670 or visit our website at safeharboroh.com.
All right, and that does it for today's episode of Financially Fit Radio with our host, Cory Sickles.